Hi, and welcome to the last ratio we're going to look at for our operating efficiency ratios. We've already had a look at the expenses ratio, and now we're going to turn to looking at the accounts receivable turnover ratio. So this ratio is an interesting one, and it's one that students I find often remember because it's quite unique. The formula is this. We take our sales revenue and then we divide it by our accounts receivable. As you'll know, that our accounts receivable is the money that's owed to us. It's money that we're waiting on to be paid to us. It's the opposite of accounts payable, which we're waiting to pay out to other people. You would know that in business, businesses work on, or many businesses work on invoicing each other. So it means you take the good or the service today, and then you have a responsibility, a legal obligation, to pay back within 30 days the amount of money owing. We record the money owed to us in our accounts receivable column. Now, so we'll run that calculation. We'll divide that the sales by our accounts receivable. That'll give us an answer. But then we do another step. It's slightly tricky. We take a full year, 365 days, and we divide it by our answer. And that will give us a response. That will give us the number of days it takes to have our accounts receivable paid to us. Okay, so let's run an example really quickly. Our sales is $178,000. Now our accounts receivable is $28,000. That gives us 6.357. So we take our full year and we divide it by our answer. And that gives us 55. But 55 what? It means 55 days. It means on average it's taking 55 days for our creditors to pay us the money that's owed to us. Okay, so it's important to note that the industry standard for being paid is 30 days, 28 days to a month. Now, don't freak out if you get you calculate it and it says it's taking 32 days on average or 35 days on average. We have a small degree of tolerance for this. Even upwards of 40 days, maybe beyond 35 you do have a problem, but you're still not panicking at that point in time. Beyond 40 you have a big problem on your hands. I only say this because I do see students calculate 31 days and they just will say the business is in a terrible position, everything needs to be repaid within 30 days. We should have a small degree of tolerance for when things are paid. Okay, I'm not going to bore you with this again, but you need to calculate your ratios. You need to compare it between is it good or not, is it healthy or sick, and then you need to make a recommendation. All right, we'll move through this quickly as usual. You have a 30-day period to pay back. Beyond 40 days is a real concern. Beyond 35 days is probably a real concern. Now, what do we do? If we have this problem, the strategies are we can offer a discount for early repayment. We can say, if you pay back within the next 2 weeks, we'll take 10% off your total bill. And businesses will respond to that. They'll think, okay, let's pay now, we'll save 10%. Also, businesses should be more careful about who they grant credit to. If someone is constantly late on paying them back, they should stop doing business with them because it's just too costly and they should try and find other customers. Lastly, they should also factor. Factoring is a really useful strategy here, not listed, but you should sell off your accounts receivable at a discount, slight discount, but you get it all today, and then you worry about that factoring company can worry about chasing up the debt. They're the debt collectors, they're good at that. In order to find this, you're going to need to look at the revenue statement for your sales info, but then you're going to have to look across at the balance sheet for your accounts receivable info. Okay, so let's have a quick look at how to do this. Here we have our sales info is $181,000, and we're going to divide it by our accounts receivable. And that gives us 11.31. So we take a full year, 365 days, and we divide it by the answer that we got, and that gives us 32 days. Okay, so here we are. It's not no cause for panic at all. 32 days is pretty good, actually. So it's slightly beyond, but it's not particularly poor. If the business wanted to improve, it could offer discounts for people who paid early. Okay, but it probably doesn't need to start panicking and go into factoring or stop doing business with people because it's not too bad. Okay, I'm going to run the example. Press pause, have a turn please yourself. Okay, so our sales for 2014 was 329,000. Our accounts receivable was 56,200. That equals 5.854. Take our full year and we divide it by that answer. And that gives us 62 days. Okay, clearly we have a big problem now. That's taking 2 months for someone on average, for people to pay back stuff they promise they pay back within a month. So here we have, it's well beyond the tolerable level. The business needs to take immediate action. The business should use factoring, offer discounts for early repayment, and be more cautious about who it extends credit to. Okay, last one, please. Press pause, have a go at that, please. Okay, our operating income was 181,000, and our accounts receivable was 67,000. So we divide that, we get 2.7. We take a full year, we divide it by that answer, 2.7. That gives us 165 days. Okay, it should be obvious to you the business has a really huge problem on its hands. 165 days is much too long. It needs to use factoring. It definitely needs to stop doing business with these people, the people that are late repayments, and offering some sort of discount may help. Okay, that brings us to the end. So subscribe to the channel, please. There'll be lots more videos going up to help with the HSC. Leave a comment if you want to see me do something. If you've got a suggestion about something, if you're not understanding something, I'm happy to do a video for you. Even if you want to know who this guy is over my shoulder, we can talk about that as well. And give the video a thumbs up or a thumbs down. See you later.